If you care about your money and your retirement, this might be one of the most important updates you hear this year, because there's something happening behind the scenes at the Federal Reserve, and this time it isn't about interest rates. Sometimes I feel like a financial weatherman. I'm here to tell you when storms are forming before they hit your savings. And the reality is, we've been through these storms before: 2008, 2018, and the pandemic. Each time, Americans were told everything's under control until the storm hit. Retirements shrank, savings lost value, and most people didn't have time to act because they didn't know what was really coming. Now a new storm is building, and I want to let you know what to look out for so that this time you can prepare. Before we begin, remember to like this video and subscribe for more economic updates. Since mid-2022, the Federal Reserve has been running what they call quantitative tightening, or QT for short. That's the technical term. Here's what it really means in plain English. The Fed owns trillions in U.S. Treasuries and mortgage-backed securities. Under QT, instead of replacing those Treasury bonds when they mature, the Fed lets them vanish. To be precise, at the start it was $95 billion per month, then that was reduced to $60 billion worth of Treasury bonds and mortgage-backed securities disappearing every month. Loans become harder to get. Markets become more volatile. Retirement accounts lose their cushion. It's a pressure you can feel, but you can't quite see. And while that's been happening, the Fed has been raising interest rates at the fastest pace in over 40 years. So not only were new dollars harder to create, the existing ones were being drained away. That's their version of fighting inflation. They make money scarce in an attempt to slow down the economy. But soon, that's all about to change. On December 1st, quantitative tightening will end. For the first time since 2022, the system will stop shrinking. Odds are you won't see any headlines about it. No big press conference, no major announcements. But make no mistake, this is a turning point. The direction of money itself is about to reverse. The Fed has confirmed that it will end balance sheet reduction on December 1st, 2025. That sounds pretty harmless, right? Well, here's the truth. They're not expanding the balance sheet yet, and they're doing this to avoid using the phrase quantitative easing. The Fed balance sheet has gone from around $9 trillion in May 2022 down to around $6.5 trillion today, losing nearly $2.4 trillion during that period. Those dollars have to be replaced, and the only way to do that is by creating more of them. So while the balance sheet looks flat on paper, new money is entering the system to keep it from shrinking. It's stimulus without the headlines. It's essentially quantitative easing without the label. So whatever they want to call it, we all know what's going on. Think of it in stages, because every monetary cycle has them. Stage 1 was quantitative tightening, the drain, liquidity leaving the system, pressure building everywhere else. Stage 2 is where we are now. The drain stops, but it takes new money just to keep the level steady. And Stage 3, if history holds, is expansion, when the flow turns back on and the system starts to swell again. Remember, we've seen this all before in 2008, 2018, and 2020. We've watched our retirement swing in value. We've seen the cost of living rise faster than our savings could keep up. And each time we were told that everything was under control. Maybe that's why the Fed is being so careful with its language, because it realizes how quickly confidence evaporates when the public understands what's going on. But we can't let language disguise the truth. Let's look back at what happened each time this cycle returned. because you've lived through all of them. During the 2008 to 2011 financial crisis, the economy froze, 401ks shrank, and fear replaced confidence. The Fed opened up the floodgates with full-scale QE. Gold rose in price over 87%, silver surged in price over 380%. Then came the pause from 2018 to 2020, when the Fed said it was only a temporary adjustment. As markets wobbled, gold climbed over 55% in price, silver more than doubled in price, up over 107%. Next was 2020 to 2021, during the pandemic response. The world shut down, the Fed printed trillions to keep the system going. During that period, gold moved up in price over 32%, and silver rose 130%. 3 different cycles, 3 different headlines, but the same playbook and the same result. Here's one important detail that's easy to miss. Each time, silver has outperformed gold, and there's a reason for that. Silver doesn't have just one driver, it has 2. It moves with gold as a store of value, and when liquidity returns, it moves again powered by the increase in industrial demand. That's why in each cycle, silver's moves have been sharper and faster. So here we are again, another cycle turning. Once QT ends December 1st, the balance sheet will freeze in place instead of shrinking. But to keep it there, new money has to come in. So while the balance sheet looks flat on paper, liquidity in the system starts rising again. History tells us what usually comes next: growth built on newly created dollars. Interest rates are expected to fall in 2025 and 2026. That means more money in the system, cheaper money, and the same limited supply of real assets. History shows us that this type of situation has never been kind to the dollar. But time and time again, it's been the moment when metals wake up. And now we're standing at that crossroads once again. As your financial weatherman, I've seen this pattern before. Calm skies, quiet confidence, and then the storm hits. You've lived through this before: 2008, 2018, and the pandemic. Each time, most people didn't see the storm coming until it was too late. Now, the Fed just issued a weather forecast. Quantitative tightening is ending. Liquidity is reversing. Now you know what might be coming.
Sign up for your one-on-one web conference with Augusta Precious Metals today. No commissions, no pressure, just education. Click the link in the description to learn more.